Well, a little bit of a sell-off today, right? We sort of had yesterday as we traded down to the middle of the session from the previous day. Today, we get some further distribution. I've remarked on Twitter, you can tell when the market is choppy when you have to keep bumping over your support levels over to the right because we remain in that same range. So we're going to break down today's sell-off, how it fits into the long-term picture. Think about some of the sector themes that we want to review. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Good afternoon. Welcome to this edition of the Final Bar. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Thanks so much for joining me today. And every day, I know a number of you have been with us since we started last week and really appreciate it. Tell your friends. Happy to have more on the show to sort of unpack the price action of the day from a technical perspective. And we're going to get to a mailbag section in a little bit. But as one quick observation, a number of you have asked about geopolitical events, right? There's the China trade agreements, there's Brexit, there's all the political challenges in the U.S. and elsewhere. And so how does that fit into the mosaic? And I'd remind you that the point of this show isn't to address all of those things. It's really to address the technical perspective. And here's the reason, right? As a holistic investor, as a well-rounded investor, I would argue you need to have the fundamental, the economic, the macro pictures all as part of your mosaic. But the technical, the visual is a really important component. And that's where I find people don't spend enough time. They don't spend enough time analyzing, also just learning and addressing it. And so what I hope to do with this show is help to fill out that part of your toolkit, fill out the technical toolkit so you can use it along with other things that you're doing. And one of the worst things you can do behaviorally is to have an opinion, have a sense of the geopolitical environment, and then look at the chart to try and get some sort of confirmation for your preconceived views, right? The point of technical analysis, the point of charts is to take an unbiased, pure view of the price action. Focus on the evidence, focus on where investors are voting with their opinions, with their feet, with their money, and use that as one of your inputs. So the short answer is yes, broad macroeconomic information is really important. You will not find me address it very often on this show because I want you to focus on the charts and then relate it back to what you've seen. So having said that, let's look at the price action today and see how it fits into the big picture. As I mentioned in the introduction, I joked on Twitter that you can tell we're in a choppy market or a sideways market when I keep having to bump my Fibonacci retracements over to the right. I haven't done it yet today, but you can see how we just keep coming back to the same price range, right? The same level of congestion, the same demand area, a level at which buyers have come in before. And it's all about where we're at relative to some of these previous levels. And, the market has memory. The market remembers certain price levels because for you as an individual investor, a lot of times, price levels will have specific meaning based on what you've done around those points. So the key is to think about that long-term framework. And what I'm seeing now is as we've sold off, closing just below 2,900 again, this is where we were sort of last week after the big sell-off day. Then we had the recovery. Then into the weekend, we've now rolled over again, coming back to the midpoint of the sell-off from last week. I mean, the pattern certainly feels just distributive to me. And again, that's more of a subjective take, but objectively, a downtrend is a pattern of lower highs and lower lows. And regardless of how you're looking at the chart, I don't think you can deny that that's the pattern that we've seen, right? We keep having a lower high. This high that we had yesterday now confirmed as a distribution because we followed through to the downside today. And now we've established a lower high, and now you have to focus on this previous support range and see if we violate it. What's interesting now is we have a confluence of technical values, technical support levels from a Fibonacci retracement using the June to July rally. So this is 61.8% of the way down. That's around 28.40 and change. Then we have the 200-day moving average around 28.45 that also lines up with all these support levels from August. So we have sort of this confluence of support, this level at which a number of times the market has bottomed, and that's sort of where I would be focused on, just to identify where we move relative to that clear support level. And you would overall expect some support. If you violate it, that's where you have to really get worried, because a lot of people will use that as a signal of potential lower move from there. Let's break down the action a little further, looking at some of the different broad indexes. And here I like to use the ETFs just to get a good, pretty consistent view about asset rotation and asset allocation. So at the top, we have the Dow down 1.2%, the S&P down a lot further, 1.5%, the NASDAQ down 1.2%. So a real significant distribution day there. Looking at some of the major index, Dow Utilities down the least, followed by the NASDAQ 100, the S&P 100. Down at the bottom, we have transports, mid caps, small caps. So we're back to that same pattern where the biggest names are sort of at the top here with a technology-oriented index sort of holding up fine, but then the more speculative small cap, mid caps down a lot further. Looking at sectors, it's a clear rotation today to more defensive parts of the market with real estate and utilities at the top, followed by consumer staples. Down at the bottom, we have financials. And we've looked at the chart of the XLF a number of times over the last week, and that's why it's such an important one. This further distribution that we see really sort of tells you that there's potential further downside. So out of all these things, what actually worked? And I'd remind you that regardless of what the broad market does, you will often have places where little pockets of positive returns, and gold is one place where we had it, the GLD, which is a play on really a spot gold price, right? It's physical gold, up 0.87%. Gold is one of the, arguably more attractive long-term charts. So we certainly saw some potential follow through here. And then globally, there are a couple markets here in Asia that were up a little bit, South Korea and Taiwan, but most of the index is down pretty significantly. Gold, when we get down to the bottom in terms of commodities, gold okay, silver, one of the better charts out there, up almost 2% today. So looking at the market summary page, a lot of times is a really good way of identifying those pockets of some positive returns out there. So I'd encourage you to look at that if you haven't yet. Wanted to remind you that later in this show, we're going to be having the mystery chart. We did this a couple times last week and ended up being pretty interesting. Wanted to share with you the mystery chart for the day. And again, the idea here is this is a chart. It is something, and I'm not going to give you any more than that. The question to you is, what is this chart? We have the chat room going on the StockCharts TV page. So if you want to go over there and put in your guesses while I'm talking with on some other things, feel free to do it. Toward the end of the show, we're going to unveil what this is and why it's an important market for you to pay attention to. So again, the question here is, what is this mystery chart? We'll unveil it later in the show. Want to switch now to the Final Bar Mailbag. Want to thank all of you that have written in questions to the Final Bar at StockCharts.com. We're also on Twitter at Final Bar SCTV. Encourage you to follow us in both places. And again, anytime you have questions, just shoot me an email, and we monitor that pretty closely, and happy to address some of the questions that you're throwing out. So I just want to hit a couple of questions very quickly that we got in the last couple days. And thanks again, everyone, for putting in questions. Yesterday, we spent time with the RRG charts, the relative rotation graph. And again, if you're not familiar with this and had some questions just on the mechanics of it, I'd encourage you to look at Julius de Kempener's work. He hosts a show on StockCharts TV. It was on earlier today on sector breakdown, sector rotations. And it's a really, really time well spent for understanding this visualization. Also on Chart School, you'll find some helpful descriptions and videos about the RRG. But the question was on the weekly RRG, which is what I tend to use, versus the daily, which is a different version that you can use. And you can switch that in the upper right. You can toggle between the two. So I'll show you very quickly between the two why I use the weekly. It's all about your time frames. And so the question you first have to ask is, on what time frame are you trying to win the game? Are you trying to outperform? Are you trying to generate alpha? That should answer the question of onto which of these you want to do. In the short-term time frame, if your time frame is a couple days to a couple weeks or anything shorter, in general, broadly speaking, you'd want to bet on mean reversion, essentially meaning you want to tend to sell things that have been working and buy things that have not been working, because there's a natural mean reversion on that time frame, right? Things that are weaker tend to rally back higher, things that are stronger tend to work back. So if I was thinking of it broadly, and again, I don't use this as a trading system or anything, but if I was thinking of it as an input, I would be looking at things that are strong on the daily and expect some rotation down on that shorter term time frame, and things that have rotated lower, like the XLE, really aggressively going down and to the left, you'd expect at some point then to improve a little bit. Something like consumer discretionary, arguably in maybe an attractive point here, short term showing some rotation. But for me, my time frame tends to be a little bit longer. I tend to be thinking 3, 6, 12 months down the road when I'm looking at charts. So for me, the weekly time frame makes more sense to me on that investment horizon, right? So here I'm looking at rotations for the last 4 weeks. It's drawing data from even further behind that. And so it's illustrating this overall rotation from the more offensive part of the markets to the more defensive part. And that's what we broke down yesterday when we talked about the RG. So, all else being equal, I'd love to use both and think of the weekly as the long-term view and the daily as the short-term view. That's a great way to do it. But given just one, I would prefer to use the one that's in line with my investment horizon. That's why I use the weekly. So I would encourage you to answer that question on your own. How, what's the time frame you're operating on? And that hopefully will point you to the right starting point for your analysis there. Second question was on Fibonacci retracements, and we're certainly going to spend time on a future show digging into it in further detail. I have it on the S&P chart, and then the question was just very simply, how do you use Fibonacci retracements? And, for me, I would say this. For me, the number one input I have using charts is price itself. So you will hear me often talking about price movements relative to support and resistance levels. Are we making a new high, a new low, a lower high, a higher low? All those things help to capture the overall trend. So when I see a market making lower highs and lower lows in a stepwise motion, I have to be leaning more negative than positive, all else being equal. What Fibonacci retracements allow you to do, though, is give you some sort of framework. So there I'm kind of on my own, just thinking, here's what the price is doing. Fibonacci retracements give you a frame of reference, right? It gives you price levels that you might expect some sort of support or resistance based on the trends that have come before. And two reasons why I think this works. Number one, just visually, when you have a market that rallies significantly, like the S&P from June to July, and then it sells off, the 38.2% and 61.8% support levels often are a reasonable level to pull back to, because if something's just in a consistent uptrend, this is just over a third of the way down. And when we get to that point, just visually, it feels like we've pulled back enough that if the uptrend is going to resume, maybe we've pulled back to a viable point. And a lot of people, I think, just very subjectively see that. That's about where you'd expect some support to come in anyways. The second reason I would say these are widely used in the investment community, and I've worked with financial professionals most of my career, and many of them, especially traders, hedge fund investors, usually will use Fibonacci retracements as some sort of levels, because it's all about levels at which you might want to be adding or subtracting from positions. So the fact that I've seen enough people use them is what convinces me that they're worthwhile. I usually just show them on long-term basis, but if you're more of a short-term investor, they certainly can be helpful trying to capture some short-term swings within the movements there. Third question that I wanted to just very quickly address was in the terms of moving averages. So I've shown a number of charts on here, and as you can see, I usually have some moving averages on my charts. This is sort of the standard daily chart that I use, which is a one-year daily chart using the 50 and 200-day moving averages. So the 200-day in red, the 50-day in blue, and then it's the RSI, and then the relative strength. That's stock versus the S&P 500. If I switch to the weekly chart, this is sort of my default weekly chart. You can see that I've updated that. So I have the 40-week and the 150-week. So someone asked, why don't you just use the 10 and the 40-week? Because doesn't that line up with the daily chart? And the short answer is you're absolutely right. But for me, it's all about the time frames I'm trying to capture here. So for me, when I'm looking longer term, I want to use longer term moving averages. I use the red 40-week because that's pretty close to the 200-day. It's about the same. The data is a little different, but about the same time frame. And so that's why that tends to make sense. The 150-week I found is a much longer term average. And I'm looking less at where the price moves relative to that moving average, but looking more at the slope of the moving average. So if a stock is going up and the 150-week moving average is sloping higher pretty consistently, this thing is just kind of working over the really long term, over multiple years. It's kind of working on an absolute price basis. When that starts to slope downwards, that tells you that, we're starting to rotate lower. Recent weeks are weaker than previous weeks. And that's arguably showing some rotation to the downside. So again, the moving averages I use are just trying to capture the trends that I'm looking at over those timeframes. And again, the way that I'm using them, it's looking at the price relative to the moving averages, but also just trying to smooth it out over the right period of time for that. So in terms of how you use moving averages, you can certainly use a lot of different settings. And trust me, I've seen a lot of people use a lot of different things. I will tell you just from my experience, 90%, if not more, of the people that I know that look at a daily chart have these two moving averages on there, the 50 and the 200-day. And that is probably the biggest reason why I tend to pay attention to it. When I'm thinking of charts, I'm trying to essentially quantify everyone's behavior, their fear and their greed and their emotions, but also as much as possible, get inside the head of all the other investors that I'm competing against. And if I can look at what they're looking, I'm feeling pretty good about having a good read on what's moving these stocks. And so that's why I use the 50 and 200-day. I'd encourage you to experiment on your own and see what happens. So thanks again for sending questions into the Final Bar mailbag. Again, anytime you can, the Final Bar at StockCharts.com, shoot us an email, or on Twitter at Final Bar SCTV. We're going to take a quick break. I'm going to come back with my friend Steve Strazza from All Star Charts, break down the markets. We'll be right back. Hello, everyone. Good afternoon. Welcome back. This is Dave Keller with StockCharts.com here from our headquarters in Redmond, Washington. Thanks again for joining us today on the Final Bar. I want to welcome on my guest, Steve Strazza. He's an analyst at AllStarCharts.com. Steve, thanks so much for coming on the show. I appreciate it.
Thanks so much for having me.
You very kindly sent 4 charts ahead of time. I'd love to quickly go through these 4 and just get us a sense of what you're seeing. The first one was on precious metals versus commodities.
Yes. So like you were alluding to earlier in the show, gold is one of the more attractive long-term charts right now, as is silver. So during a period like this, or an environment where the equity market isn't exactly trending, we're just kind of chopping and moving sideways and have been, since January of 18 now, you can look elsewhere, in this case, the commodities market, for markets that are trending. And right now that's precious metals.
Very interesting. And it's fascinating. The momentum has spiked up so quickly on that ratio just recently, right?
Yeah, I mean, we got 2 overbought readings, 2 separate overbought readings since prices started to break out of this long-term consolidation in 2018. And really what that's showing is that, buyers are becoming more aggressive. And even though this is just comparing and looking at the trend relative to equal weight commodities, which aren't a very strong, it's not a very good looking chart on an absolute basis right now, equal weight commodities. But still, when you look at that breakout, there's clearly something going on. And what that tells me is this is probably a secular trend, or the start of a new secular trend, and that within the commodity complex, you want to be in precious metals.
Very interesting. So on those lines, the second chart you sent us was a long-term chart on gold. So I did not mean to scoop your beautiful take here on gold, but talk us through it. What are you seeing here?
No, so this is just gold in US dollars, the top chart, and this is based since 2013 and built out a really nice consolidation. And we recently resolved higher above that 1400, say 1375, 1400 level. Right. And right now we're kind of digesting the gains off of May's low. We picked up about 20%, and we're kind of moving sideways right now. And I think that the trade has a lot more room. If you look at it in other currencies, scrolling down here, we already made new highs. Gold already made new highs in other non-US dollar currencies. So I have it here in yen, Aussie dollar, and then euro. And I think US dollar is going to be next. I think we're actually going to continue trending higher. It could take a year or two, but I think we'll eventually take out those highs. So I think this is a trade that, long-term investors could really participate in, and it's not too late to enter.
It's a great lesson to look at gold, not just in US dollars, but maybe in other currencies, see what sort of confirmation. That's really interesting. This third chart was on gold to silver ratio.
Right. This one's really important. So the story here is, the bottom line is that when gold and silver are in uptrends, or when precious metals are in a bull market, silver is the higher beta way to play the trend. So right. What you see is investors pile into silver, and silver actually moves higher or trends higher at a faster rate than gold. So you have this dynamic where the gold to silver ratio actually rolls over and trends lower, which is highlighted. Those periods are highlighted by green in this chart. And what you see is that when the gold to silver ratio is moving lower, silver is outperforming gold, but both precious metals, silver and gold, will be normally trending higher on an absolute basis.
And that is an expert illustration of the annotation platform on StockCharts. Kudos for that, Steve. Well done. And then your final chart is another one on the silver to gold ratio. What are you seeing here?
So this is just a zoomed in version and inverted version of the previous gold to silver ratio. So this is silver to gold. We have gold in the denominator now. And what this is showing is we have a potential failed breakdown, which could result in a very fast move higher in both precious metals. So I think if we get that failed breakdown in this ratio and silver starts to outperform gold, that's going to be a signal to investors, and it's probably going to be happening in an environment where both precious metals are moving higher, and you could be invested in either one. It's just silver's going to give you more beta.
There's such a great behavioral lesson there, Steve, on inverting the chart, and we've talked about it on the show before about how you try to disconnect from a preconceived bias, right? And just by inverting it, you're sort of addressing it from a different perspective. That's really, really well done.
I have to do it because I see things differently. When I invert the chart, I have a bullish bias. So a lot of times when I'm looking for shorts, I have to invert those charts.
So we're almost out of time. I'd love just one final question if we could. Going back to your weekly chart on gold, and I mentioned earlier, it's one of the better long-term setups, and I think your chart sort of backs it up very well. My question is, what would you see that would convince you otherwise, right? What would you see on this long-term chart of gold that would tell you, you know what, it actually isn't a good long-term play anymore, or maybe I need to revisit that? Is there any particular signal break or something that you would look for?
I have to be honest, it's not so much the absolute price chart of gold that I'm concerned with, to make sure that this is actually a real new structural bull market. It's other things like outperformance from the miners over spot gold.
Got it.
Outperformance of silver over gold, like we just talked about. The US dollar, I don't want to see continuing higher. I'd like to see it roll over here,
Sure.
DXY. So it's things like that I'm really looking at. As long as gold continues to, just kind of march higher on an absolute basis, I think we're fine. But if it does break back below that 1380 or 1400 level, it would invalidate my thesis.
Steve, that was a fantastic take on the metals. Thanks so much for sharing your thought with us, and thanks for coming on the show. We appreciate it.
Thanks so much for having me on, Dave.
Ladies and gentlemen, that's Steve Strazza from StockCharts. This is a great take on precious metals. Knows his stuff, and I love the illustration of gold versus silver. Just seeing it this way visually with shading in the background, it's just such a simple visual cue, but helps you make sense of what we're seeing. That's really, really well done. I hope you found that to be time well spent. Have you figured out what the mystery chart is? Do we have any guesses from the chat room on the mystery chart? Here we go. Producer holding up the cues. Good guess. IWM, Russell 2000. Good guesses all around. Some of you are actually very correct. I either need to come up with more challenging ones. With challenge accepted. I will do it. You're really close. It is actually the IWM, which is the Russell 2000 ETF. This is a little different chart than the one I showed you, but hopefully gives you a sense of it. So well done, everyone that guessed this. It's interesting how similar, but also how very different the small cap chart looks versus the S&P 500, right? And you could tell it was something related just because of the relative movements up and down phases. But the fact that it's been so decidedly sideways, and what strikes me about this chart, is the 50 and 200-day moving averages are completely, right in the middle. They're flat. They're touching. There's a little bit of movement, but overall, like the market really hasn't gone anywhere in a long time. So that's one thing that strikes me, just the sideways nature of it. But also the fact that, again, not knowing anything else in the world, if you just looked at this chart, we're really testing this key support level. This 144 to 146 level has been support for the Russell 2000 for a while now, right? Going back to sort of April, May, the sell-off there into the low in June and the rally. But we revisited those same levels in August, and now we're coming back testing that same support. We've bounced off, and now potentially kind of coming back and testing that level. And I think if you see something like the IWM break down through 144, that key support level, I don't know about you, but I feel a little concerned about that one. I did not include the RSI, but while we have it up here, I would say it's worth noting, like we talked yesterday about the S&P 500. I like using the RSI just for getting an overall sense of where we're at within the sort of normal expected range. And you can see how the RSI hasn't become neither overbought or oversold all the way since February, right? Since that big rally out of the market low last year. So it's really been the definition of a sideways trend, right? No real clear momentum, buyers or sellers not really taking control. If we would break below that support, if we would break below 40, if we would get down to this oversold region, in my opinion, that tells you that sellers arguably have maybe started to take control, push this a little lower than expected. So, boy, job well done for many of you. That was well done. Good guessing. I promise I will continue to make these harder. The good news is I'll run out of some of these easy ones pretty quickly. I'm going to have to make it a little more complicated, but that's our mystery chart for the day. Make sure you're familiar with the small caps versus mid versus the large caps. Going to wrap up the show today with the 3 and 3. Again, every day I like to boil it down to the 3 charts that if you're not looking at these, I'd encourage you to incorporate them into your process. These are just key charts that I've come across in my sort of daily routine going through stock charts and looking at the visuals. And again, hopefully you can come up with your own list. Start to bookmark some of these in a chart list, come back to them and see how they evolve over time. The more you do that, I think the better sense you're going to have of market rotations. This first one is sort of a play on the growth versus value theme. A lot of people look at the broad growth and value indexes, which is totally fine. One of the challenges with that, if you just look at a simple ratio of growth versus value, is some stocks like Microsoft is usually the example I think about, are actually classified as both growth and value because it's like a big growthy company that's pretty established, I guess, right? So it's a little misleading only because the ratios will look a little different depending on the types of names that are working or not. These two ETFs, the RPG and the RPV, are a pure growth and a pure value. So stocks are only counted in one of those two buckets, and arguably gives you just a cleaner sense of the rotation from growth to value. And the reason why I think this is an interesting one, when the market's rallying, when this ratio goes to new highs, this is back in August. All of a sudden it's thinking, all right, growth is working. Then all of a sudden when it turns over the first week in September into the second week, I can't tell you how many times I heard comments about momentum being dead and value, the return of value. And all of those things could continue to evolve. That could happen at some point. But, there was definitely a rotation right back into the growth rate. It's sort of, if you covered up this 2-week period, the trend just kind of resumed like nothing ever happened. So it'll be interesting to see if we continue to see this appreciate, saying a return back to growth as being just fine. Or do we rotate lower? Do we break down to a new low for the year? And if that's the case, I think you have to certainly be thinking more on the value side. Look for value types of names that could be working. A lot of that is certainly based on a sector rotation for sure. The second chart, sorry, I went a little out of order here. Second chart, give me a second. Oh, here we go. I just mislabeled them. Sorry about that. Second chart is American Express, AXP. So looking at an individual name, again, I like to do a lot of screening, looking at stocks and how they're breaking up and down, using the scanning engine, using the scooter rankings. This is one that popped up for me because it was breaking down through the 200-day moving average, and that also lined up with the Fibonacci support level, also lined up with this low from June. So look at this rotation from accumulation to distribution, making lower lows, lower highs, now breaking through this confluence of support levels. We were talking about moving averages earlier. We were talking about Fibonacci retracements earlier, and this looked like a really good illustration of a stock that's potentially starting to violate those. And the final confirmation would be a break to new lows below 111. That would suggest further downside for AXP. The third one is stocks versus bonds. I like to look at the spiders versus the TLT. It's just a simple play on stocks versus bonds. If this is going up, it's favoring stocks. If it's going down, it's favoring bonds. And even with the recovery that we saw in the equity markets, look at how this ratio has continued lower for the last 3 weeks. And with today's down move in stocks, just appears to be continuing lower and further lower. So that clearly illustrates more of a rotation to a sort of a defensive, sort of safe haven type of asset, going from equities into treasuries. If that continues lower, I think you need to be worried a little bit about potential further downside in stocks. And as that goes lower, people know that they need to go to high dividend yielding stocks or into the bond markets to look for the returns that they're trying to expect from their cash. So that's the 3 and 3 charts to pay attention to. I want to thank everyone for joining us today on this edition of The Final Bar. As always, you can email us at thefinalbar@stockcharts.com. We check that often. I welcome any questions on topics we've shown, but also on stockcharts.com in general. You can also get to us on Twitter at FinalBarSCTV. We'll look for there for questions as well. I want to thank my guest, Steve Strazza. He's the analyst at All Star Charts. Really appreciate him coming on. Hope to have him back again soon. From Redmond, Washington, stockcharts.com, this is Dave Keller saying, have a great night.